And welcome to the next in our series of virtual webinars with the investment team. And thank you for sharing a moment of insights with our investment professionals. I hope you're going to enjoy the day with us. In this session this morning, we're going to talk a little bit about the latest market trends, what we're experiencing and what we're seeing. And we'll be asking some of our asset management professionals to give you some insight into how they're experiencing the markets and what the risks and opportunities are as they see it. We'll be starting off with Herman van Papendorp. He will be sharing a little bit of our economic and market views with you. That will be followed by Wayne Dennehy and Lofty Botha. They will be sharing a little bit of our growing smart beta capability and how that's been faring in these turbulent markets. After that, we'll have a quick panel conversation with our asset management team to talk a little bit about their key priorities and insights in the markets, and also how they're seeing and experiencing their portfolios during these turbulent times, especially with COVID, how they're finding it difficult or easy to manage their portfolios and navigating the environment in a sensible way. For that panel conversation, Ian Scott from our fixed interest capability set, as well as Pelio Manyaneng from our listed property capability, will also be joining us. We will also throughout the morning be involving you as an audience, so please be ready for that. We want to keep it a little bit more interactive and interesting. And you will also have an opportunity a little bit later on to ask some questions when we get to the panel conversation. For the time being, let me maybe start with Herman and ask Herman a little bit about 2020 and what's been happening, especially in the global equity markets. I mean, it's been quite a torrid time for equity, global equity especially, since the beginning of the year in Feb and March, when we had that sharp sell-off and the asset class really struggled. But since then, it had quite a sharp rebound. And where are we now as you seeing it, and also in relation to other asset classes?
Yes, hello, Sonia. Thank you very much for that introduction. Good morning to everyone. I think if we look at global equity markets at the moment, in our view, there are a number of downside risks to global equity markets. So we're feeling a little bit more uncomfortable at the moment with global equities where they are after the significant rebound that we've seen. And I'll try and highlight a couple of these equity risks to you in the next number of slides. And I think the first sort of risk that we want to highlight is that we think that consensus earnings numbers are way too optimistic at the moment in the global space. If you look at what history tells us in the US, for instance, we see that in the last three recessions that we've seen in the US, it normally takes about 3 years or more before you reach the previous profit peak after you've seen such a significant recessionary kind of condition coming into the framework. But if you look at what consensus are saying at the moment, and you look on the right-hand side of this slide, you see that consensus are already telling us that by the end of next year, so after 2 years, we will already be back at the kind of profit levels that we were before COVID. So, and that seems to me to be highly unlikely if you look at the kind of shock that we've had to the system, if you look at the kind of indication that you get from history. So that's the first worry that we have, that the consensus earnings profit expectations are too high in global equity markets. Then if you look at the second risk that we want to highlight is that all the liquidity injections that we're seeing from global policymakers are not necessarily getting into the economic system. And I show this graph specifically to show the kind of QE that the Fed has undertaken since February of this year. And we've seen the red line, $3 trillion of quantitative easing done by the Fed since February. Now, a lot of people will look at that and say, well, that is much bigger than what we saw in the global financial crisis. So surely that means that, it's much more positive for the global economy. But what we need to also realize is that at the time that the Fed has been injecting liquidity into the financial system, US banks have actually withdrawn money out of the financial system because they've become much more worried about credit conditions. They've become much more conservative. They're not lending out into the system. So what they've been doing is they've been putting more money in their reserve accounts at the Fed. So that $3 trillion of QE from the Fed has been almost negated by the $2 trillion of increased reserves that the US banks are holding at the Fed. So again, it's only a net $1 trillion that's actually gone into the US economy. So again, that is not as positive as a lot of people will think of the stimulus. The third risk I want to highlight is the fact that we've obviously seen the significant sell-off in 2020 of global equity markets. You see that in the red line left-hand side, but you've seen then a significant rebound. So much so that we now sort of at the kind of levels that we would expect to be at during the last 50 years of recessions globally, where equity markets should be. So if you look at the dark black line, that's the average performance of global equity markets over the last 50 years of recessions. So what you'll see is that where we are on the red line is very much at the black line at this stage, after obviously a significant downward move and a significant upward rebound. But that would also mean that going forward, there's still some downside risk if we use history as a guide for global equity markets. The only question is, are we going to see the playbook of the 1980s recession, that yellow line? That will mean that we're down about 10% from current levels over the next 12 months. Or are we going to see the playbook of the global financial crisis, which will mean that we could be down by another 50% if you look at the green line on that specific scale. But be that as it may, very much still indicative that history will tell you there's downside risk from current levels. If you look on the right-hand side of this specific slide, what we've done here is we've had a look at what the equity prices were doing, global equities, at the time of the market peak in February. So that's the red line. And we've put that at an index of 100 together with an index of 100 on 2021 earnings. So next year's earnings numbers globally. And what you'll see is that the red line fell significantly during the sell-off, significantly below the 2021 earnings numbers, even below the 2020 earnings numbers. But since the bottom of the market on the 23rd of March, we've seen this red line trading right through the 2020 earnings numbers and right through the 2021 earnings numbers. So much so that we're roughly 10% above the earnings numbers of 2021 at the moment. So again, a lot of positive discounts of earnings projections at the moment. And we think actually that these blue lines, as I've just said in the previous slide, is the blue line actually has downside risk. So global equity is way too optimistic at the moment relative to global earnings. If you look at the sentiment in the market, Citigroup does a panic euphoria model. They put a lot of sentiment indicators in this specific indicator. And what you will see at the moment is that we are at the most euphoric levels of sentiment in the US since basically the tech bubble in the early 2000s. So I've put those two little circles there to give you an indication of the euphoric levels that we are at the moment at, and much more euphoric even than what we saw in the global financial crisis. Now, why this is important is if all the good news is in the market is euphoric as far as sentiment is concerned, there's only downside risk to negative surprises. And what you normally find is that these bars normally show you that the 12-month following returns are actually negative after you reach these kind of euphoric levels. So again, another risk or a downside risk for equity markets globally. Then obviously, if you look at the virus, we have the risk of further infection waves that could come up as the economies start opening up gradually. So this could induce things like a W kind of shape or even a square root shape in the economic trajectory, in the market trajectory going forward, as we see the ebb and flow of the new cases globally coming through. And then we've got the US election coming up in about 4 months' time. And what you normally find is that in any 3 months of US equity returns, you normally have about 2.5% kind of returns over the last 30 years. But in the 3 months before the US election, you'll see on the right-hand side, there's downside risk for equity markets. Equity markets don't perform so well in the run-up to a US election because they're uncertain about whether the current incumbent will stay in power or whether there will be someone new with new policies. So expect potentially some volatility in US equity markets with some downside risk as well as we build up into the election in November. And what you will probably see is that both candidates will probably push the trade war rhetoric quite significantly, even more so if we have a Democratic president. Biden comes in, He's running on a ticket of higher tax rates, also of higher minimum wages. That both of those are negative for corporate profits and therefore negative for earnings as well. I want to show you two slides just on how equities have performed during the sell-off and the rebound relative to other asset classes. And what I've got here is a lot of spaghetti lines, but I'll show you from the 19th of February, peak of the market, to the 23rd of March, most asset classes were in agreement that this is going to be a serious issue, the virus. It's going to be a serious economic issue and a serious risk-off issue. So equity markets sold off, so their prices went down. The rand with other emerging market currencies as risky currencies, they sold off. And US Treasury yields went down as the world's predominant risk-off asset. But what has happened since then has been very much a disconnect between global equities and the rest of the asset classes. What you will see is that global equities, whether it's the Russell 2000, which is the smaller cap index in the US, whether it's the S&P 500 in blue, or whether it's the NASDAQ, the dark blue line, all of them have seen a significant rally since the bottom of 23rd of March. But bonds in the US, the world's risk-free asset, says, well, no, we don't believe that this is a risk-on kind of environment, because bond yields stayed at those low levels that they were at the bottom of the market on the 23rd of March. And also the rand stayed very much the green line at the kind of levels that we reached on the 23rd of March. So the rand didn't rebound, US Treasury yields didn't go up. So rand, bonds, they don't buy the equity optimism at the moment. Another way of looking at it is to look at previous recessions and to look at what the typical behavior of asset classes are in previous recessions. And here you can see the probability that the US equity market at the moment attaches to US recession is only 17%, 1-7. Whereas the US bond market, in this 5-year US Treasuries used in this instance, very much 100% probability at the moment of recession. So there's obviously this disconnect between where equity valuations and levels are trading relative to what the bond market is telling us about the kind of risk-on, risk-off behavior out there. Now the question then is, if we're worried about the downside risk for global equities, does this now mean that we need to buy global bonds as the world's risk-free assets? Now the problem there is that although absolute equity valuations are not looking great, bonds are even looking significantly worse as far as valuations are concerned. So it's not a great idea to use asset allocation and go overweight US bonds and underweight US equities to try and defend yourself, your portfolios against downside risk. I'll show this on the top side of the left-hand graph. Just in green, we've got the earnings yield on global equities. You'll see it's around 5% roughly. Now the 5% earnings yield, that's roughly a 20 times PE. But if you look at the previous time that the market was, the equity market globally was this expensive, was again in the tech bubble of the early 2000s. You'll see that there the earnings yield was also around 5%. But look at the difference between where bonds were at that time and where bonds are now. At the time that earnings yields were quite expensive in global equities in the early 2000s, 5% earnings yield, bonds were also close to 5%. So if you look at the equity risk premium, if you subtract bond yields from earnings yields, very much around 0. So equities were very expensive relative to bonds in the early 2000s when earnings yields were at these kind of levels. But now bonds are at 0. So the differential between the two very much gives you an equity risk premium of around 5%. So equities very much on an earnings yield gap basis looking very attractive relative to bonds. So you can't really use the bonds, which are massively expensive at global yields of around 0, to defend yourself against the downside risk for equities. We show that on the right-hand side as well, just on a PE basis, so that just the inverse of the earnings yield give you very much same kind of picture, that the US equity market at the moment on a trailing PE of 23 times, but US bonds at around 60 basis points have got a 150 kind of PE if you would use that as an indicator. And then if you look at the relative earnings yield gap, it's quite interesting, very long-term time history that I've got here. If you look at the earnings yield on a trailing earnings basis, so the last 12 months earnings relative to the bond yields, you can see that we are now the cheapest of equities in the US relative to US bonds that we were since the Second World War. You can see the Second World War, just after that, we were at these kind of very cheap equity levels relative to bonds. If you use normalized earnings to do the same exercise, so normalized means over the cycle, over the last 10 years. So I use the last 10 years earnings. You'll see that the equities are now the cheapest they've been relative to bonds since the Great Depression of the 1930s. So again, let me conclude by summarizing our view on global equities and global bonds. I've shown here, yes, there are a number of downside risks to global equity markets, but it's also true that in relative value terms, global bonds are much worse than equities. They've got no margin of safety as far as their valuations are concerned. Therefore, we would rather hedge the equity exposure to downside risk than use very expensive global bonds as a defensive asset allocation hedge.
Thank you, Herman. That's certainly very insightful. It's been a long time since we've seen that much downside risk in the global equity market. So thank you for sharing that. Please let me also ask the audience, if as we go along through the morning, if you've got any particular questions for any of our speakers or panelists, that you post that in the Q&A box, and we will try and address your questions as much as we can in the panel conversation. But we can also follow it up if there are unanswered questions. We can also follow that up with an email afterwards. So please do continue posting questions as we go along. Next up, we are going to talk a little bit to Wayne Denny and Lofty Botha. Now, as I said at the beginning, they look after our smart beta capability. It's been a very successful but a growing capability set for us over the last couple of years. Wayne, would you mind sharing a little bit with us in terms of how the smart beta portfolios has been faring and what you're seeing happening during this market condition?
Morning, Sonia. Morning, ladies and gentlemen. Thank you very much. Sure. I think I would say pretty much, unless you've been in some sort of medical coma for the last 4 months, it really has been one tough roller coaster ride in South African equities in the last 3 to 4 months. And I thought, as a start, let me actually just go and have a look and see how the various equity funds have performed by screening them in terms of what their what the actual underlying benchmark was, because clearly not all equity funds are going to be equal in terms of how they behave relative to what their benchmark was. And for me personally, what I saw was actually quite surprising. And what came out of that is that if you look at the slide on the right-hand side, what it's showing you is that in the last 1 year, on the first sort of mustard chart, that the market capped SWIX total return index effectively gave a market return of minus 14% for the last 1 year, and that's a total return index. So that includes the reinvesting of your market dividends. But exactly the same funds with a market benchmark of the actual all-share index did significantly better over the 1 year. I mean, it did really 8% better than had your market benchmark been capped SWIX. And you can see on the two sort of charts to the right of that, that it's a very similar picture over the last 2 years, where the market cap weighted index on a capped SWIX basis did minus 15%, but the market all-share index did minus 3% over the same period. So a really big difference depending on what the actual underlying benchmark was. What surprised me even more is that if you went over longer time frames, exactly the same story seemed to have unfolded. So over 3 years, you can see there that our capped SWIX index at minus 12% actual return, whereas the actual market all-share index was actually now showing a positive return over the last 3 years. And quite astoundingly is that on a 5-year basis, there really has been no positive return in South African equities if your market benchmark was a capped SWIX benchmark. And this is a fundamental point for us as a fund manager and for you as clients and as sort of ultimate advisors to make sure that your clients understand what is the actual risk profile of that particular equity building block. Should you be on the actual all-share index where you're going to have potentially 25 to 27% of your exposure in 2 shares, or should you be in a sort of a more gentle capped SWIX fund where we're actually going to cap that exposure to 10% into any 1 share? Certainly no right or wrong answer, but a more risk mitigating strategy in our sort of capped SWIX strategy certainly hasn't been kind to us in the last 5 years relative to a market cap weighted strategy. I thought let's just, so prior to having a look at our smart beta equity funds and how they have actually performed, let's start with just a quick recap of what is the fundamental difference between a market cap weighted fund and a smart beta fund. And it's really simple. I mean, in a market cap weighted fund, effectively you're buying the market. So you're buying shares. The holding of the shares in the fund is directly proportional to the size of the market. So the larger the share, the larger the holding in the fund, the smaller the share in the market, the smaller the holding in a fund. In your smart beta fund, what we're trying to do here is to capture a particular market style. So we're trying to capture styles such as value, such as quality, such as momentum, and we're trying to build funds that actually do that in a systematic way. So rather than using active share selection, active share screening, what we're doing here is we're actually forming a view on what shares to put into, for argument's sake, our value fund based on certain criteria. And everything that we do in our process is that we screen shares on multiple risk factors. In our view, it's the only way to build smart beta funds that will behave consistently through various market cycles. Of course, as a market industry, we've done our best to try and confuse clients here because it goes by so many different names: smart beta, systematic beta, scientific beta, advanced beta, but they're all in essence doing the same thing. They're holding shares in the fund where the weighting is anything other than by their size to try and capture a particular style. So if I look at what the smart beta funds are that we have within our own suite, we effectively have three. If I start in the middle, we have a momentum value fund. No surprise, I think we'd all be well versed on what a value style is actually trying to capture. And that's been in existence now for a little over 3 years. On the left-hand side, we have our momentum trending equity fund, which, as you can imagine, presented a very challenging naming challenge for us because it ultimately is the momentum risk premier in our market. But that name would have been a real conundrum. So it's called by what it is, the momentum trending equity fund. That also has a 3-year track record. And our momentum quality smart beta fund, we launched nearly 12 months ago. So it's coming up for a 1-year track record. And that effectively makes up our suite. We've got about 11 billion in these 3 smart beta funds, and they really give a tremendous toolkit for advisors and for clients to add different building blocks into their portfolios to build more robust end solutions. So let's have a look at how these funds have performed over the last 3 years, and I'll hand you over to Lofty Buerta, who is the underlying portfolio manager that looks after these funds on a day-to-day basis.
Thank you, Wayne. Good morning, everybody. So we have 2 pure strategies or styles, as it's also referred to. We've got the momentum trending equity unit trust and the momentum value equity unit trust. So we're pleased to share that over the past 3 years, our clients experienced an outperformance in the trending equity unit trust of almost 10%, and in the value around 3% per annum over 3 years, and that is despite very tough market conditions. You can see on the bars on the left-hand side, there's the trending and the value. The performance came from many small bets in line with its style, but also by missing a few big problems in the market, like we missed Steinhoff completely. We had nothing in Steinhoff when it collapsed. And for example, Sasol, which is an interesting case because over the last 6 months, it declined in a big way, and that added also value to the fund. But the more important thing is that you must add consistent value by getting things right, and all these incrementally add up, and that is where we like our performance to come from. If you compare these 2 unit trusts against peers, the trending over the 3 years is first out of 143, the 3 years to June, while the value, the first 2 years of its launch, value was in vogue, but the last year, not so much. However, it's still second quartile against its peers, and it's still way above its objective, and the objective, as I mentioned, is 1% outperformance per annum over rolling 3 years. Then on the next slide, I show what our value composite is doing. We don't have our quality composite. We don't have quality unit trust yet. We're waiting for the FSCA, but I believe it's in the final stages. And when there's a flight to quality, this fund does exceptionally well. So even in this 10 months till May, that's on our SEC funds, gross of fees, and the outperformance on these subset of funds, or composite as we like to call it, was 6% outperformance, because obviously quality was very fashionable in these times. On the next slide, I would like to talk about a little bit about cross-sectional volatility. So if you index cross-sectional volatility and you look at the average, just to give you a feel to calibrate it in your mind's eyes, during the global financial crisis, it was double normal cross-sectional volatility. While at the moment, the average of the last 3 months or so was 3 times average cross-sectional volatility. And that cross-sectional volatility is just a way to describe how stocks within a certain period are dispersed. So the one is performing tops and the other bottom. And yeah, and you've got a high dispersion, especially at the moment. So if one look at what happened to Sasol, over the 6 months, Sasol is down almost 60%. But if you unpack it a little bit further into the 2 quarters, it moved from around 300 to 30. So it's almost down 90% over the first quarter. And then in the second quarter, moving from, say, 30 rands to about 130 rands on the red chart. That is up more than 250%. So it is extreme conditions, and you cannot, as they say, dance at every wedding. But we were underweight this period, and it added materially over the 6 months to our performance. Another thing of this cross-sectional volatility, these performance never move in a straight line, and one can expect surprises as long as this is at elevated levels. So we can either, yeah, and the obvious way to address this cross-sectional volatility is not to go and buy into one focused style or strategy fund, but to diversify. And like one of our products that Wayne will allude to when he's on soon. Then on the next slide, clearly we are doing the things right by getting the performance that I showed you earlier, but we're also doing the right things. And just to look again at Sasol as an example and ESG, so we have a very focused ESG team, and they engage with companies where they think it's necessary. So in Sasol, we have holding nothing in the smart beta. However, we hold Sasol in the index funds. Now, Sasol is a very important and strategic company in South Africa. However, it's getting a lot of attention from a negative perspective on the environmental issues. So our ESG analysts engage with him, and it is one of many small impacts on Sasol. So we raise our voice, and he was ensured that Sasol will implement policies to address ESG issues, and also that they're appointing a director who is an expert on climate risk to advise the board on its policy. Yeah, and that is from my side, Wayne.
Okay, I don't seem to be able to start my video, but let me carry on with the slides. So let me then run into effectively how do sort of retail clients access these sort of styles and these sort of strategies in our unit trust platform or through our wealth platform. And what we've done effectively is we built out, sort of also roughly 3 years ago, we built out what we call the Momentum Core Equity Fund, which effectively is a blend of all 4 of these sort of strategies. On the most simplistic, it's our CAPS-FIX index fund, so effectively your buy the market fund, and our 3 smart beta funds, being trending, being our quality, and our value funds. And this fund also now has been running for roughly the last 3 years. I think it talks to, this is exactly how we build out our SA equity building block in our institutional portfolios and in our multi-managed portfolios. It's not just about diversifying between a few managers. It's very much about, within the space, how do we diversify between styles? So we've got the 3 styles, trending, quality, and value. And then how do we then diversify between managers if we need to? And that's, to us, gives us a far better representation of our SA equity building block in what is ultimately a very passively and smart beta managed underlyings. How this fund's done, bearing in mind it's got a live track record of more than 3 years, and it's got more than R1 billion worth of third-party funds on our unit trust manco, it really has performed exceptionally well relative to its peer group, as you can see. The yellow graph on top is the fund return since its inception date in 2017. And the two lines below that effectively represent the FTSE JSE Cap Swix All Share Total Return Index and the average of the ASISA General Equity category. Also important to bear in mind that, these particular equity funds and our 3 smart beta funds have no explicit offshore equity allocation. It's only buying equities on the local JSE exchange. So in that context, when we all know how the Rand has performed in the last 3 years, the fact that our 3 smart beta funds, and this fund in particular, have performed exceptionally well shows and gives us tremendous faith that they really have sort of made it through what's been a tough market time and really given superior outperformance to clients in that journey. So to close this conversation, I think really the fundamental message that we can give through to clients is that if you invest in only one style, so if you were to invest only in, for argument's sake, value, or only in, for argument's sake, trending, you really are going to potentially have a very bumpy ride through different market cycles. The way that you get a smoother ride is to actually blend different styles into your SA equity portfolio. And there's 2 ways that you can do it. If you're working through a strong financial advisor, or if you realize that you're missing something in your portfolio. So if you were to ask clients, who are your value managers in your clients? Clients would generally have a very good idea. Chances are, though, that they're all actively managed value management by style. What we've shown you this morning is that you've now got the option to add a smart beta value SA equity into that diversified range. Or you could add trending, or you could add quality. Or if you're just looking to get access to the SA equity market in a completely passive way, without having a sort of active manager selection risk, we have our core equity fund, which effectively is our house view with a blend of those various styles. So we've really got something that can talk to everyone. For clients looking to get access to the SA equity market in a blended best investment view, core equity. If you're looking to add a particular style to your portfolio to further diversify, or if you want to actually diversify between active management styles that you might have in your portfolio, here you have all the ingredients to help you in that journey. Thank you.
Thank you, Wayne and Lofty. Thank you for giving us that oversight and an update. I think a big congratulations to both of you as well with clearly what has been a tremendous track record that you've built up. It's nice to see that you can, on a cheaper basis, get all the components that you can from an active equity portfolio and be in a position to replicate it. So well done with that. Just a reminder to our audience to please continue posting questions on our Q&A box. Apologies for the glitch a little bit earlier, but we're going to continue with the panel conversation soon. We thought it's a good idea to maybe involve you a little bit, so I think it's a good time for us to go to a bit of a poll. If you don't mind participating with us in that, now that you've heard Lofty and Wayne talk about our smart beta capabilities, we are keen to pull up the first question, and that is about our investment styles. So you can just simply click on the option that you feel is most applicable and submit the answer. The question is, what investment style do you think is best placed going forward? So which one do you think is going to perform best, and would you like to invest in rather a value, a momentum, a quality, or a blend of styles? That momentum obviously is sort of our trending strategy as Wayne described it. Please submit your questions and we'll see in a couple of seconds what the answer is. And we'll also get a feel for whether Wayne and Lofty convinced you in either direction. So let's get a bit of a view. And there are the results. Well done, Wayne. I think your conversation convinced everyone that a blend of styles probably is the best approach to go with, and certainly also something that we can echo from our multi-asset class portfolio, something that we like to use. Let's maybe move on to our panel conversation then. If Ian and Pelu can also please join us. Ian, as everyone knows, Ian Scott is the head of our fixed interest desk. Maybe let me start with Ian and ask him a little bit about our bond market and what's been happening. We certainly have seen an eventful year globally as well as in South Africa, Ian. We witnessed sovereign downgrades. We saw the SARB having to inject liquidity into our system. We had poor government finances. So we've certainly had our challenges, and we also then, on top of all of that, had 2 budgets within 4 months. So certainly a very eventful time for you and the team in the bond markets. Give us a little bit of your sense of what this means for the forward valuation and what you see as the expected returns for bonds going forward.
Good morning, Sonia and everyone. Yes, 2020 has been eventful so far. You've seen a graph earlier from Herman where he said, the Fed has done over 3 trillion of QE this year, but it's not just the Fed. We've seen it from all the major central banks in the world. We've seen the ECB, the Bank of Japan, the People's Bank of China. You can all name them. They've done a massive amount of QE. What does it actually mean? It is a massive tailwind for global bonds. Now, what Herman says is true, is that global bonds are very expensive. They might not protect you against inflation where they're trading. So just to put it into perspective, we always put it in terms of where inflation is. So in the US, inflation is probably around 1.5% at the moment and falling, but the 10-year bond is trading at 0.6%, so not getting a real return there. Conversely, what we've seen in South Africa is that the yield curve actually steepened because of poor finances, and we have very high real returns. So to put it once into perspective is that Tanisha is looking for about 3% inflation this year, and our 10-year bond is trading at 9.5%. So it means that the real yield, or the real return that we can expect from bonds over the next couple of years could be around 6%. Now, 6% real is equity type territory, but we're taking bond risk. So we think South African bonds in the middle to short end of the curve is very attractively priced on a real yield perspective, because you're getting real equity like real yields at bond risk. So yes, we're very excited about the valuation of the South African bond market.
Pelu, maybe to you, looking after our listed property proposition in the market, we certainly see COVID-19 having quite a sudden and dramatic impact in how people operate for obvious reasons. So certainly that started playing out into the office market. And I mean, this morning we talking to our clients on a virtual basis. So a lot of way of work have adopted for companies to be more virtual using platforms like Zoom and Teams. What do you think that trend towards working from home is going to mean for the office market?
Thanks, Sonia, and good morning to everyone who's joined us. We think that the trend towards working from home is going to leave scars in the office market, in our view. We think that the key driver that will accelerate the adoption of working from home going forward, and potentially even make it sticky, is the fact that we're going into an environment where we're going to see economic contraction, and with that, the amount of revenues that companies will be able to generate will shrink as well. So with that, I mean, we've seen over the last 3 months, we've been working from home, and one could potentially say that the experiment so far has actually worked fairly well, minus the glitches here and there like we experienced a few minutes ago. But I think when company executives look at that, the results of that sort of experiment, and they consider it in line with the turnover that's coming lower, working from home will potentially be one lever that the companies can actually pull to start saving costs. So we think that we'll probably see a number of companies deciding to scale back on their office space, and that will have negative implications, obviously, on occupancy rates going forward. If our estimates are correct, we could potentially see vacancy rates doubling from here onwards. And to actually reduce that, we'll have to see significant amount of growth coming forward to drive vacancies lower. But we're certainly not in the camp that suggests that the office market is dead, but we think that coming out of this environment, demand for offices will be slightly less than it was going in.
Okay, thank you, Pelu. Let me read some of the questions from the audience. I think I'm going to address this one to Wayne. Wayne, as someone who has never invested before, Do you think it's a good time now to start investing?
Thanks, Sonia. That's a real tricky one. I think it certainly always must be a good time to start investing. I think the key factor I would be considering in these volatile markets is certainly don't go and take your life savings and put it into the market overnight. It's all about getting into the market in a more controlled way, averaging in, I would say, high risk now. If you take your life savings and put it into the market in one shot, if you're making a unit trust investment month to month, absolutely no wrong time to invest now. Even if the market crashes, you're going to buy future months at a lower price. So definitely, if you haven't started, now's the great time to start.
Okay. Thank you, Wayne. Maybe another good question that I'm seeing here from the audience. Ian, I'm going to ask you to respond if you don't mind. We've seen that equity and property counters on the JSE started suspending dividends. So, and the dividend distributions rather. So that means that it's got an immediate impact on the income being generated from those companies. And certainly it could mean something positive for the fixed interest space, given the fixed nature of the coupons. So give us a little bit of your view of whether that's a continuous trend and what that means for bonds going forward.
Yes, thank you, Sonia. In all our dealings, we're obviously dealing with a lot of management teams of companies and corporates and the property sector at this point in time. And remember, we are lenders to all these sectors, and we as debt holders are encouraging them to not pay dividends or pay distributions, because if they obviously withhold distributions, it strengthens the balance sheet, and it obviously strengthens the investment case for bondholders like ourselves. But what it would mean for, as Pele would well know, for the property investors and equity investors, they're not getting income. Remember, when you invest, there's two basically returns. It's one is the income stream and the other one is the capital stream. Now, we think the income stream for the next year or two on the equity market and the property market will be very constrained because companies are withholding their payments. But remember, with fixed income, we sit right at the top of the capital waterfall. We have to be paid. We're like a bank. If they don't pay us our coupons, we can declare default against the company, which is disastrous. So no matter what happens over the next 2 years in terms of dividend distributions, we have to be paid our coupons. It's part of the debt of a company. So for investors investing in portfolios, you're also looking for income. And as you get older, you want higher income. So if you are a more pensioner or pension-related type investor, you need that income. Where do you get the income from? You don't want to go and sell equities to pay for your monthly income. That's why we think South African bonds should have a fairly high allocation in funds and investment portfolios at this point in time, because it will deliver income for investors, especially over the next 2 years at a real rate, because the average coupons in the South African bond market is probably around 8%. So once again, inflation is 3, the coupons are 8, you're going to get a real return from bonds without taking a massive amount of interest rate risk or capital risk on your portfolios.
Thank you, Ian. Another very topical and relevant question, and I'm going to ask Pelu and Herman maybe to respond, is around the valuation of property and what we see in property counters and whether prices reflect that. So certainly property has taken quite a severe beating this year. But what is your view on where property valuations are right now? And do you think that the share prices of the listed counters reflect those valuations, or what's your view?
Thanks, Sonia. Maybe let me just start off by responding to the previous question from a property perspective. Sure. I think when we were obviously going into the lockdown, we were, as a team, very worried about the liquidity of property companies. And we were advocating for retention of dividends. And when property companies came out to say that they will not be paying dividends, that's a stance that we supported. But we were pleasantly surprised as time went on to see the level of collections that some of the companies were actually managing to collect from a rent perspective. Some counters that we hold in the portfolio collected up to close to 100% over the last 3 months, while the other counters experienced less rental collection, ranging between 50 or 70%. So I think the payout of dividend will be company specific. There are companies that will pay, and we'll support that if cash flows and solvency has been sorted out. And there will be companies that have stretched balance sheets that we would not be supportive if they wanted to pay out dividends. So from that perspective, I think we would see those that pay out and those that do not pay out dividends. So on average, we could be looking at lower dividends, but certainly it's not a situation where dividends will not be paid out in totality over the next couple of years. Just on touching on valuations, that's, I think, the question that we've sort of received over the last 12 months or so. Our view is that valuations will come under pressure, just given the environment that we're operating under. And our analysis suggests that we could see anywhere between 10 and 20% decline in values. Again, it's going to be company specific or property specific. There will be those counters or properties that will experience more than that on the downside, and there will be those that experience less than that in terms of downside expectations. But we're looking at a range between 10 and 20%. Do we think that's reflected in share prices? We think so. On average, as I said, our worst case scenario is about 20%, and we think the market is pricing in 30%. So we think if our estimates are correct, we potentially could see some upside in terms of share prices of property companies from here onwards.
Let me just add on that, Sonia. Very much from an asset allocation perspective, obviously we've got to sort of counter any specific asset class view with whatever is available in the rest of the asset class range. And I think, again, you know, when we look at listed property, a lot of the bad news is in the price. But from a risk-adjusted perspective, we think that some of the other asset classes are looking more attractive. So, you know, when we look at our return expectations, we think, yes, over the next couple of years, there's probably asymmetric risk to the upside for listed property returns, because a lot of the bad news is in the price. But when we look at our portfolios, then we say, you know, we've got to add to the fact that, you know, to the return fact, we need to add that there's a lot of uncertainty still there in the property space about how much property valuations will go down and whether the sentiment will return and whether, you know, some of the companies will really cut their dividends to the bone. And therefore we say, you know, risk-adjusted return space, we prefer some of the other asset classes. I mean, Ian has referred obviously to vanilla bonds, sort of the government bond side. That we like much more than what we like the listed property space at the moment, although they're sort of normally driven by the same things. The risk-adjusted return is just so much more favorable in portfolios looking at fixed income relative to listed property, even though the absolute returns is probably the risk to the upside for listed property at this stage.
Okay, thanks Herman and Pelu. Maybe that's a good opportunity for us to do our second poll. Having listened to some of the panelists and Herman and also Pelu's view now, let's get our second question up just in terms of what our audience thinks the best asset class is going to be going forward from a local perspective, that is. So which local asset class do you prefer in the current environment? A, equity, B, bonds, C, cash, or D, property? Let's get everyone's views on. Again, you can just click on the option you prefer and submit. And then let's maybe see what our audience is feeling from a polling perspective. Bonds. Well done, Ian. I think you, between you and Herman, made a good case there for bonds. And equity being in second place, and the last cash and property sort of in the back of the lot. So that's an interesting view from our audience in terms of what's going to win going forward. Let me read one more question. I think, Herman, you'd probably be best placed to respond to it. Do you think the debt to GDP projections put forward by Tito Ngubeni are fair, or do you think it's too optimistic?
Well, remember Tito and the Treasury, they've got a couple of scenarios. I mean, they've got their base case, which shows that debt to GDP ratios go to 87, and then they've got a worst case that it goes to 114. I think probably somewhere between 87 and 114 is probably the realistic case to look at. And, you know, we'll have to see how they play this over the next couple of years, in what kind of revenue generating opportunities they use and how much they cut spending. So I think, you know, is it realistic? Well, it depends on which scenario you look at. I think it's probably somewhere between their base case and their worst case. And then you obviously got some opportunity to actually use external funding, like, you know, the IMF, the World Bank, and so forth, that you can actually use in this kind of instance to finance some of your debt as well. So I think from that perspective, you know, I think it's going to be a dire environment for debt to GDP, for fiscal, over the next number of years. I mean, I think we would be very much unrealistic if we expect that the fiscal mountain that we need to climb over the next 10 years is going to be, you know, disappearing over the next 2 years. I think it's a long-term worry that we will have over the next number of years.
Okay, thank you, Herman. Lofty, I think this one is maybe addressed to you. Is there evidence that companies that are paying out dividends are better quality and coming up in your quality screen for the quality portfolio, or how are you viewing companies with dividends? I mean, does it typically slant company, the stock picks you do in the smart beta quality portfolio to companies that are paying higher dividends?
The dividends doesn't actually feed into the quality screen. So we look there on profitability until the earnings level, but not through to the dividend level. However, it compensates in a big way for that, because cash flow or free cash flow is a big portion of that. And then the quality also, we look at reported. So if the dividends, depends when a company reports. So if it, and when the year end is, so some might have 0 dividends and some might still have in the base. So it's probably better that we don't look at it systematically in the quality. In the value fund, we do indeed put a lot of emphasis on dividends, but we combine it. We look at historic dividends plus forecast dividends, and both of them in combination tells a story, and that's how we navigate this. So at the moment, we put a lot of more forecast into forecast dividends than historic dividends than we would have done in the past.
Okay, thank you, Lofty. Ian, a question for you from the audience. I'm worried that if I have a medium, let's say 5-term investment horizon, and I invest into bonds, that interest rates could increase significantly as we are currently at very low rates, implying that the market value of my investment would be much lower when I disinvest. What is your view on that?
Yeah, thank you for the question. That is obviously the theory of bonds. When interest rate rise, it's negative for bond yields. I will counter it, and that is true when bond yields are actually expensive. So if you go over a very long period of time, you would see that the real yield on the 10-year bond on average in South Africa was around 2.5%. Now I said to you that currently it's probably it's around 6.5%, nearly 7%. So bonds in South Africa are very cheap. It's pricing for a lot of negative news around South African growth and South African government finances. So even if the SARB does put up rates, we don't think the bond curve will be that negatively affected, because bonds will go from very cheap to maybe even, I don't know what is cheaper than that. The problem with bonds is when they're at a very expensive level or fair value level, and the SARB suddenly puts rates up because inflation is spiking, that's when you have a problem with bonds. But at the moment, bonds are cheap. So theoretically, to put it quickly into perspective, if inflation in South Africa over the next year, 2 years, it's probably 3 or 4%, putting 2.5% on it means the bond yield should have been 5.5%, 6.5%, but it's sitting at 9.5%. So it is actually very cheap. It's trading at, call it 80 cents in the rand. Now remember, bonds mature at 1 rand in the price. So there's a lot of capital appreciation that will also happen. So over the next 5 years, even if rates do go up, we don't think the medium to short end bonds would do that badly, because they are reflecting it in the price already. It's not to say it won't happen, But bonds is also not a perpetual investment like equities. You have to review your position. Bonds are liquid, and when you need to get out, you need to get out of bonds. It's not a buy and hold forever.
Thank you, Ian. Maybe one last question for Pelu. Given all the concessions made by REITs, are the percentages of rent collected based on the amount of invoices currently issued for rent or based on the book pre-COVID?
Can you repeat the question again, Sonia?
Given all the concessions made by REITs, are the percentages of rent collected based on the amount of invoices currently being issued for rent, or is it based on the book pre-COVID?
So it's so property or in terms of the lease agreements, tenants have to pay rent, I think, on the 7th day of every month. So over the last 3 months since the lockdown, the rent collections that we have been receiving has been based on monthly rental collections. So, I mean, the April and May rentals were significantly low. I think I may have just mentioned that we were looking at about just 70% on average, with the retail sector obviously significantly affected by that, with collections on that side sitting at around 50%. But since we moved into level 3 lockdown, we've seen an improvement in collections, and the June rental collections are averaging around, have improved to around 80%, with retail also slightly higher now at about 60% of collections. So whatever we are seeing now in terms of collections is what's being billed for the particular month. There would be, in certain instances, situations where whatever is in arrears is being captured into current rental collections, but that would be a small percentage of that.
Okay, thank you, Pelu. We unfortunately are running out of time for questions. Thank you for all the other brilliant questions. I think we'll maybe just summarize it and send out an email. So thank you for your participation. Let's maybe do one last quick poll, if you don't mind, just to get your view on what the biggest risks are. If we can pull up that last question, please. What do you think as an audience would be our biggest global risks for growth going forward? Is it A, second wave of COVID-19 infections? Is it B, US-China trade wars? Or C, a US presidential election? Which one of those do you think are the biggest global growth risks that we're facing as South African investors? Please post your question, your answer, I mean. And let's maybe pull up the answers. Thank you. I think that's quite a strong unanimous vote. 2/3 of the audience roughly saying that COVID-19 is our biggest single threat. I think Mr. Trump will also be very pleased with your third answer. So thank you everyone for your participation there. Clearly we are not through the worst of our challenges, and clearly there's still a lot of uncertainty, and as our audience also discussed, or our panelists also discussed, a lot of downside risks still in most of the asset classes. But we hope at least this morning gives you a lot of insight into how we're thinking about the opportunity set, and how our team are responding both to the opportunities and risks. We look forward to keep engaging with you going forward, and thank you for joining us this morning. Have a good day.